In the United States, one small number has the power to control your financial life. It can decide whether you get approved for a credit card, a car loan, a home loan, or even an apartment. That number is called a credit score. Many people in the United States earn good money but still struggle financially. The reason is not always income. Very often, the real reason is a poor understanding of credit scores. Welcome to Finance Simplified, a finance education channel where we explain money, credit, and personal finance in simple English for beginners in the United States. In this video, I will explain what a credit score is, how it works in the United States, why it is so important, and how it affects your everyday financial life. This explanation is simple, beginner-friendly, and designed for people who are completely new to U.S. personal finance. A credit score is a three-digit number that shows how responsible you are with borrowed money in the United States. It tells banks, lenders, and companies how likely you are to repay money on time. In simple words, a credit score is a trust score. It answers one basic question: can this person be trusted with credit? In the United States, most credit scores range from 300 to 850. The higher your score, the more trustworthy you appear to lenders. The lower your score, the riskier you appear. Your credit score does not show how rich you are. It does not show how much money you have in your bank account. It only shows how well you manage borrowed money. This is why someone earning a high salary can still have a bad credit score, while someone earning a normal salary can have an excellent credit score. To understand credit scores better, let's talk about why they exist in the first place. In the United States, the economy runs on credit. People use credit cards, auto loans, mortgages, and student loans every day. Banks and companies lend trillions of dollars to consumers. But before lending money, lenders want to reduce risk. They want a system that quickly tells them whether a person is likely to pay back the money or not. That system is the credit score. Instead of personally knowing every borrower, lenders rely on your credit score as a summary of your financial behavior. If your credit score is high, lenders feel confident lending you money. If your credit score is low, lenders become cautious or may reject you completely. Now let's talk about the credit score ranges in the United States. Credit scores are usually divided into 5 main categories. A score between 300 and 579 is considered poor. This means lenders see you as very risky. With a score in this range, it is difficult to get approved for credit cards or loans. If you do get approved, interest rates will be very high. A score between 580 and 669 is considered fair. This means lenders see some risk but not extreme risk. You may get approved for basic credit products, but still with higher interest rates. A score between 670 and 739 is considered good. This is where things start to improve. Many lenders feel comfortable approving credit applications in this range. A score between 740 and 799 is considered very good. This means you are seen as a reliable borrower. You can qualify for better interest rates and premium credit cards. A score between 800 and 850 is considered excellent. This is the top level. People in this range receive the best financial offers, the lowest interest rates, and the highest trust from lenders. If this finance education is helping you understand money better, make sure to like this video and subscribe to Finance Simplified so you don't miss future videos on credit, investing, and personal finance in the United States. In the United States, the most commonly used credit score is called the FICO Score. FICO stands for Fair Isaac Corporation. The FICO score is used by banks, mortgage lenders, auto loan companies, and credit card issuers. Your FICO score is calculated using information from your credit report. A credit report is a detailed record of your credit history. It includes your credit cards, loans, payment history, balances, and other financial data. There are 3 major credit reporting agencies in the United States. They collect and store your credit information. Your credit score is calculated based on several factors. The most important factor is payment history. This means whether you pay your bills on time. Late payments, missed payments, and defaults can severely damage your credit score. The second important factor is credit utilization. This means how much of your available credit you are using. Using too much of your credit limit can lower your score. The third factor is length of credit history. This refers to how long you have been using credit. A longer credit history is generally better. The fourth factor is credit mix. This means having different types of credit, such as credit cards and loans. The final factor is new credit. Applying for too many credit accounts in a short period can lower your score. Now let's talk about why credit scores are so important in everyday American life. Your credit score affects whether you can get a credit card. It affects the interest rate you pay on loans. It affects whether you can buy a car or a home. In many cases, landlords check credit scores before renting apartments. Insurance companies may use credit-based scores to set premiums. Some employers may review credit reports during background checks. This means your credit score can affect much more than just borrowing money. A good credit score gives you financial freedom. A bad credit score creates financial stress. One of the biggest mistakes beginners make is ignoring their credit score. Many people only think about credit after getting rejected. Another common mistake is missing payments. Even one missed payment can damage your score for a long time. Using too much credit is another major mistake. Maxing out credit cards signals financial stress to lenders. Applying for many credit cards at once can hurt your score. Each application creates a hard inquiry, which slightly lowers your score. Many people believe closing old cards improves your credit. In reality, closing old cards can sometimes lower your score. A credit score is not something you fix overnight. It is built slowly through consistent, responsible behavior. The good news is that credit scores can improve. No matter how bad your score is today, it can get better with time. Understanding credit scores is the first step towards financial stability in the United States. Once you understand how the system works, you can use credit as a tool instead of a trap. Your credit score does not define you as a person. It only reflects your past financial behavior. With knowledge, discipline, and patience, anyone can build a strong credit profile. In future videos on Finance Simplified, we will talk about how credit cards affect your credit score, how to build credit from zero, and how to avoid common credit mistakes. If you want to take control of your financial future in the United States, learning about credit is essential. This is where your journey towards smarter money decisions begins.